Hi, today we will be revising everything uh, we need to know about Forex, and we'll be delving into Forex into the deepest level we have ever been. Uh, Before I start, I want to note that this entire stream is totally for me. I'll be revising the concepts which I have learned throughout the ages, that is 3 years of consistently trading and being active, analyzing and trading in the markets. That includes cryptos, stocks, as well as forex and metals. And I want to note that everything that I'll be teaching, I don't entirely own the credits to all of these. I have rather learned everything which I will be teaching from the market, from my own personal experience, but also from many of these respectful traders who have established their own journey through the market. And I'll be taking each of the concepts, the best of them, and will be jumbling them all up in this video. So let's start. uh, we'll be starting as basic as the market price action and market structure. I'll be using the arrow tool for that. Now, we all know that market moves in two ways, that is up and down, up and down. But the market may not always move exactly like this, right? In a box manner. We also are affiliated that markets do move like this. Now, how do we exactly trade a price action like this? It's simple, and we'll start with the simplest of them all. Let's say these are all the highs, they're almost all equal, and they form a zone in which they enter and they reject. We call this as a demand. And of course, if there's a demand for something, there will always be a supply of it. Now, the demand or the supply and demand concepts, also known as support and resistance, is quite uh, self uh, teachable. I don't know. I don't have the best of words for it, but every one of us does know that these two goes hand to hand. Now, if the supply increases in the market and demand is less, the price of that certain commodity it will fall. But if there's a high demand and the supplies goes less, then the price of that commodity will rise. And that's how this works. And when the demand and supply they both equal out, then the market does not moves. It goes in a box like manner or as simple as a line. Uh, and that's what you call as a sideways market or just a consolidation or literally a horizontal line. Now, this does not happen every time since it's quite rare for market to not actually get liquidity, that is money, and it is almost impossible to match the supply and demand every time. So the market does moves in both ways, that is up and down mostly. How exactly do you trade this? No, it was not as easy as buying at the bottom with your stop losses below the supply zone and just reversing it, going for shorting and selling at the top with your stops above the demand zone and uh, your take profits at the supply. Well, to get better from the market and to catch almost all the moves, we are going to delve in more into something derivated from the smart money concept. For that, we'll be looking at something we call as order block or OB or breakup block, also noted as PB. What exactly is that? Now, let's say this is one green candle. Okay, we'll print the screen. Now, the market forms in a bullish situation, forms another great big green candle. Now, my mistake. It's not an OB. Mhm. Yeah. So, what happens in here is, let's say you were here, okay? You were exactly in here in the market and you were waiting to buy, but you just did not really buy and you were waiting all this time, the market just shooted up, okay? Now, let's say you placed some of your orders in here and thought that I'll just buy when the market comes back at this range. And what exactly happens is mostly all of these retailers does have this thought process and a large number of order gets piled up in here. This exact wick, okay, we note this via a wick. This is the wick, okay, and the order block forms from the high of the wick to the low of the wick, and this exactly becomes an order block. Now, what happens is the market returns back to this place, okay, and goes up. Now, the complexity is that the market will just touch it. That is, we also call this as tapping, or go to the middle of it, or the total below and reverse. And sometimes the market is just gonna take the market's just gonna take a little bump forward and continue going downwards. Now, how to identify what is gonna happen in the market? For that, we are gonna delve into something we call as FVGs, or the full form of it being fair value gap. Now, market creates two type of gaps, and the first one is, let's say this is one candle and this is another candle. Whatever you have in between is essentially called a gap. In this case, it's called as a gap up. Now, sometimes what happens is we often experience three simultaneous candles of note this down, of the same color forming. Now, what happens is due to such volatility increase in the market, there's often orders waiting in between which are unfilled to get filled in at a certain limit price. For that, what the market makers does essentially, they want to have the maximum liquidity in the market, either to move the market, to function the market as properly and justly, or use all those liquidity as their earnings. It depends, though. In this case, what happens is when an FVG is formed, right, the market usually visits this gap and then goes up. Now, how do you identify the gap? It's simple. Just clear this a little in here. When three candles are formed, let's say there are no wicks in here, okay? These are all wickless, boiled candles. Then the top of the the third, the most third left candle, we start from the top of it, and the most right candle, we end it at the bottom, and this whole zone is called as an FVG. Okay, but what if the candles has wicks? Now there's three things to note in that. Let's say this is candle number one, candle number two, and this candle number three. Now this is a good case FVG. Why essentially is this wick is not crossing this wick, or this candle's wick is not crossing this candle's wick. So this makes an FVG of a good kind. You start the making the FVG from the top of the leftmost candlestick wick to the uh, bottom wick of the rightmost same colored candle wick, and this makes an FVG. But what does not constitutes as an FVG is that when the third candle wicks is just two down below, that it equals out or goes beyond the third left candle, or that the third left candle wick is that big that uh it does leaves no gaps between two wicks. That makes no FVG in this case. Now, as we're talking about in the case of OBs, that when do we know that if the market is gonna take support when it comes to an order block, and when is it gonna reverse? We should always know that the market will always take a bump when it lands on an order block, at least for some seconds. Okay, but it may go down if the market has these FVGs below. Okay, now to understand that even a further forward, we will look at market structure in a deep understanding. Let's say the market was moving in a bullish manner. Now, how do we exactly trade this market? Now, we should always know, please note rather, that this is one big, these are three big wicks, okay? And thus there's an FVG in here, which the market closed. Uh-huh. Now, the market took some uh, support on the FVG and then it moved forward. Well, we should never use FVG alone, since market may always or mostly make multiple FVGs. So we should always pair it using a Fibonacci retracement tool. And we always look forward for market retracting below 50%. From 50 to 88.6 is a zone that most of the forex markets and metal markets do retrace to. So we should always use FVGs and Fibonacci together. Now, It's not that you can't use Fibonacci alone, but you should never use FVGs alone. Now, we then know that there's no FVGs below and there's strong support. So we did to take a long and 50%, had the stops below 88.6% and a profit at minus 50%. That gives me a good 2 hour trade that if you risk 1% of your account will make you or will make you 2%. Now, why did the market go below? Let's say, let's say there was an unfilled OB below in here, and the market thus visited this point before going further upwards. But why did the markets exactly go further upwards? Now, there might be some kind of liquidity residing. Okay, there can be two kinds of liquidity. But before we get into this, we will get into all the possible explanations on why the market did visit below or why the market did plunge up from here. Now we did cover that FVG is there, okay, along with Fibonacci. There can be one more thing, markets forming equal lows. Now equal lows can be formed in two ways. Please note, it can be that there's a lot of numerous wicks between two wicks which has equal base or equal heights, or there can be just two candlesticks